Income subject to tax. Amounts of income from all sources inside or outside Canada, whether received in cash, as goods, or as services, are taxable to a resident of Canada unless specifically exempt. What is income? The Concise Oxford Dictionary, 7th ed. 1982, defines income as periodical receipts from one's business, lands, work, investments, etc. The Gage Canadian Dictionary defines income as what comes in from property, business, work, etc. Receipts, returns. These general definitions are made more specific for use in taxation. In a somewhat roundabout way, the Income Tax Act defines income as the aggregate of amounts that are. This definition is the basis of our discussion of reportable income. Amounts not included in income. Although the above definition of income is fairly comprehensive, there are some types of income which the Income Tax Act explicitly states are not to be included when computing a taxpayer's income for the year. In addition, there are other types of income that are not included simply because they do not fall under any of the broad categories of income described in the Income Tax Act. These types of income are never entered anywhere on the tax return. Commonly encountered amounts of this kind include income from an office or employment, income from a business property, capital gains, other sources of income as specified by the Income Tax Act, pension benefits for example. Income earned on any of the above amounts, such as interest earned when investing lottery. Winnings is taxable. How can we calculate income on a tax return? 1. Total income. Most GIS and inheritances, most lottery winnings, winnings from betting or gambling for simple recreation or enjoyment, most payments of the type commonly referred to as strike pay, even if performing picketing duties as a requirement of membership, most amounts received from a life insurance policy following someone's death, compensation paid by a province or territory to a victim of a criminal act or a motor vehicle accident, amounts paid by Canada or an allied country, if the amount is not taxable in that country, for disability or death of a war veteran due to war service, RCMP pensions or compensation paid in respect of injury, disability, or death, elementary and secondary school scholarships and bursaries, post-secondary school scholarships, fellowships and bursaries for a program in which the taxpayer is enrolled full-time, income of First Nations people, if earned on a reserve, the Goods and Services Tax or Harmonized Sales Tax Credit, GST, HST credit, the Canada Child Benefit as well as payments from related provincial or territorial programs, child assistance payments and the supplement for handicapped children paid by the province of Quebec, and most amounts received from a tax-free savings account, TFSA. Note: 1. Total income. Income from all sources is entered on the return, except for those types of income that are not reportable for tax purposes, listed above. In most cases, gross income from a source is entered, for example, employment income. In a few cases both gross and net income from a source are entered, for example, gross and net rental income. In rare cases, only net income from a source is entered, for example, research grants. The sum of income from all reportable sources comprises total income for tax purposes. 2. Net income. Net income is what the Income Tax Act refers to as a taxpayer's income for the year. It is a person's total income from all reportable sources, minus specified allowable deductions. Net income is important because it is used to calculate eligibility for many tax credits and social benefits, such as the GST, HST credit, personal amounts for dependents, and the Canada Child Benefit. 3. Taxable income. Taxable income is the income on which tax is levied. This may not be the same as net income, since the Income Tax Act allows certain deductions from net income. For example, the following types of non-taxable income are deducted ere the net income line. Workers' compensation payments. How do we calculate federal tax? Federal tax is calculated as a percentage of taxable income. The federal tax rates are 15%, 20.5%, 26%, 29% and 33%, and taxes increase as taxable income increases. The resulting tax is then reduced by the taxpayer's non-refundable credits to arrive at net federal tax. Non-refundable credits are based on the taxpayer's personal and family situation and serve to reduce tax owing. However, they are not refunded to the taxpayer if they exceed the tax owing. Refundable tax credits are then used to offset tax owing. However, unlike non-refundable credits, if they exceed the tax owing, any excess amount is refunded to the taxpayer.